Welcome to Reject Regret. We are Wilson and Adil. On this channel, we are all about sharing practical lessons to help you build a better tomorrow. Today, we are tackling a topic that can feel overwhelming, but is the single most powerful tool you have for your future: investing. If you have ever felt like you don't understand the concepts of investing, or you have looked at a stock and felt overwhelmed by all the jargons and numbers, then this video is for you. So grab your coffee, settle in, and let's start designing a smarter financial future. Remember, this video is for education and entertainment purpose only. This is not financial advice. Do your own research or speak to a regulated advisor. Okay, before we get into any of the complicated stuff, let's ask the most basic question. What are you actually doing when you invest? Imagine your favorite local coffee shop is doing really well, and the owner decides to sell tiny pieces of the business to raise money to open a new location. When you buy a share in a company, that's exactly what you're doing. You're not just giving them money, you're becoming a part owner of that business. And here's how that grows your money. If that coffee shop uses your cash to sell more coffee and make more profit, the whole business becomes more valuable. And because you own a piece of it, your piece becomes more valuable too. That is the fundamental way investing builds wealth. Okay, so that's what investing is, but why is it so important? The main reason is a silent money eater called inflation. Inflation is just the fancy word for prices going up over time. If your savings account is paying you 1% interest, but prices are rising by 3%, you are actually losing 2% of your buying power every single year. The engine that fights back is compound interest. In 1 year, a 7% interest on 100 pounds is 7 pounds. In 2 years, it's 7% on 107 pounds. That extra 40p might seem small, but over 30 years, this effect becomes a financial avalanche, making your money work for you. So, you now know that owning a piece of a business is how you grow your money. But picking just one company is very risky. For most beginners, it's smarter to start by owning a tiny piece of many companies all at once. And the easiest way to do that is with an ETF or exchange traded fund. Think it of as a pre-packaged basket of investments. You'll also hear about mutual funds. They work on the same basket principle. The main difference is that many mutual funds are actively managed. This means a professional fund manager is trying to pick the specific companies within the basket that they think will grow the fastest. You are paying them a higher fee for their expertise. The next concept is index fund. Now you have probably heard people on the news talk about the market going up or down. They are usually talking about a market index. A market index is just like a report card for a big chunk of the stock market. For example, the FTSE 100 is the report card for the 100 biggest companies in the UK. If most of those companies are doing well, the FTSE 100 goes up. If they are doing poorly, it goes down. And this is where it gets really powerful. You can buy something called an index fund. Both ETFs and mutual funds can be run as an index fund. An index fund has one simple job. It's like a photocopier that perfectly copies everything in the market index. So, if you buy an FTSE 100 index fund, you own a tiny piece of all 100 companies on that list. You're not trying to beat the market, you're just matching its performance. Because this is all done automatically by a computer, the fees are usually very, very low. This is called passive investing. So to summarize, stocks or shares are a piece of one company. Bonds are a loan you make to a company or government in return for interest. And funds like ETFs are baskets that holds hundreds of those stocks and bonds for you. Okay, so funds are a great way to own a piece of the whole market. But what if you do want to pick an individual company you believe in? This is where you need to learn to separate the truly great businesses from the just okay ones. Exactly. When you see a successful company, the first question you have to ask is, what's stopping someone else from coming along and doing the same thing, but cheaper? If you can't answer that question, it's a big red flag. The answer to that question is what legendary investors like Warren Buffett call an economic moat. Think of it exactly like a castle. A moat is a durable, long-term competitive advantage that protects a company from its competitors. It's the reason a company can stay profitable year after year. And it's the number one sign of a high-quality business. According to research from Morningstar, companies build these moats in 5 main ways. First up, you have intangible assets. This is stuff you can't physically touch, but has immense value. Think about Coca-Cola's brand and secret formula. You'll happily pay more for a Coke than a generic supermarket cola, right? That brand loyalty is the moat, and it allows them to protect their profits. Next is cost advantage. This is simple. The company can make or sell its products cheaper than anyone else. A great example is McDonald's. Because they buy so many potatoes and so much beef, they get them at a massive discount that a local restaurant could never get. As an investor, that low cost means higher and more reliable profits for the business. Then there's one of our favorites, switching cost. This is when it's a huge pain, hassle, or expense for customers to leave a company for a rival. Think about your main high street bank. Switching is a hassle, right? That hassle is the moat that keeps customer locked in. Another incredibly powerful one is the network effect. This is where a service gets better and more valuable for everyone as more people join. Visa is the classic example. The more people who has Visa cards, the more shops have to accept them. The more shops that accept them, the more essential the card becomes for you. It's a cycle that almost impossible for a new company to break into. And finally, there's efficient scale. This usually applies in niche markets where it just wouldn't make economic sense for a competitor to show up. Imagine a company that owns the only pipeline running from a port to a major city. A competitor isn't going to build a second one right next to it. That basically has a natural monopoly. So how does knowing all this help you pick a company? It's a critical bridge between a company story and its financial performance. When you see a company with amazing profits, the moat answers the most important question. Why are these results so good? And are they sustainable? A strong moat is the best evidence that you have that a company's success isn't just a fluke, but the result of a durable, long-term advantage you can invest in. Okay, so you have found a high-quality company with a strong moat. The next crucial step is to figure out if you are paying a fair price for it. It's time to decode the numbers. Now, this is the part where most people get overwhelmed, but we'll keep it simple. While many people focus only on profit, a lot of professional investors start with the actual cash a company is generating. They look at something called free cash flow. It's the cash left over after all the essential bills and investments needed to run and grow the business are paid. It's often considered a purer measure of a company's true financial health because it's less affected by accounting assumptions than profit is. Exactly, so how do you use this? You can look at the price to free cash flow ratio, just like a P/E ratio. A lower number is often more attractive and suggests the stock might be undervalued related to its cash generating power. Okay, now for the most famous metric of all, the price to earnings or P/E ratio. The P/E ratio simply compares a company's price tag to its yearly profit. It's a quick way to see if a stock is cheap or expensive, but only when you compare it to similar companies. For example, you would compare Tesco's P/E to Sainsbury's, not to a tech company like Microsoft. And finally, if you are an investor who wants to earn an income from your shares, you have to learn how to avoid the yield trap. You'll see a number called the dividend yield. That's the income the company pays out to you each year as a percentage of the share price. It's tempting to just pick the stock with the highest yield, but that can be a huge mistake. That high yield can be a trap. It often happens when a company is in trouble and its stock price has fallen sharply, which artificially makes the yield look high. To check if the dividends is actually safe, you must look at the dividends payout ratio. The payout ratio answers the most important question. Can the company actually afford to pay the dividend? It shows you what percentage of the company's profits are being paid out to shareholders. If the number is consistently over 100%, it means the company is paying out more than it's earning in profit. A massive red flag that the dividend could be cut at any moment. So remember, the yield tells you what you get, but the payout ratio tells you if you can rely on keeping it. Okay, theory is great, but action is what matters. You can start investing with just £100 or even less. The first step is to choose a well-regarded, low-cost platform and open an account like a stocks and shares ISA. Once you're in, you need to understand volatility, which is just the choppiness of an investment, and drawdown, which is the potential fall from its peak. And remember the most important habits. Have a 3 to 6 months emergency fund saved in cash before you invest heavily. And never panic sell during a market dip. Your patience is your greatest asset. If you value clarity and confidence over confusion, hit that subscribe button to continue the journey with us. Thanks for watching, and we will see you in the next one.